Good morning. My name's Maurice Crespi, Managing Partner of Schindler's Attorneys. Welcome. Today, we'll be dealing with business rescue in a nutshell. We'll be going through business rescue, the legalities in relation to business rescue. But importantly, we'll be talking around business rescue. But COBRA is not about business rescue. COBRA is about keeping you out of rescue. So please bear that in mind. In this climate, the moratorium that one gets through business rescue is only required if a creditor is being unreasonable. Chances are that creditor has other creditors that he has to account to. So what we do is ask your creditors to simply join the COBRA ecosystem with a view to us then negotiating with their creditors. So the idea is we go all the way up from the SPASA level of business all the way up to bank, and we try and strike arrangements there. I'm joined by my fellow panelists, Emma Marseille from the IQ Business Group, Tasneem Khan from Schindler's Attorneys, Ian Fleming from Engaged Business Turnaround, and Peter Gordon from Engaged Business Turnaround. IQ and Engaged and Schindler's Attorneys are the founding partners of COBRA. We are over the moon to announce that we hit, 40 partners on Friday. So that's very, very good going. Congratulations to everybody for making this happen. This is South Africa's largest pro bono initiative in South Africa's history, I think. And bear in mind, the pro bono services include informative webinars such as today's. We have a knowledge base, which is the most detailed and up-to-date knowledge base in the country. You can find that on our website, www.cobra.org.za. You can set up private Zoom meetings with us to deal with issues that your team may have or industry-specific questions. Also on a pro bono basis, we can deal with your staff, deal with the legal landscape and the complexities when it comes to the labor aspect that you need to contend with now. And we'll be dealing with that today. So to kick off, I'm going to ask Peter Gordon of Engaged Business Turnaround to give us a brief overview of business rescue in general. We'll later be dealing with labor, the labor aspect specifically, surety specifically, post-commencement finance specifically, and leases specifically. So we don't need to deal with that. We'll deal with that later, Peter. But other than that, if you just touch on all the other aspects at a very high level. Peter?
Maurice, thank you, and good morning, everybody. Welcome. Business rescue, it's promulgated in the Companies Act, Chapter 6 of the Companies Act. It was in the 2008 Companies Act, which was promulgated in 2011. So it's been in our life for the last 9 years. It started off quite badly. I think there were a lot of people that decided that business rescue was a solution to companies that had already failed and would delay the inevitable liquidation. So in the early days, there was certainly a lot of court cases having business rescue overturned, and converted to liquidation rather. The important things, I'm going to cover some of the pros and the cons and the highlights of business rescue. The most important thing about business rescue is it creates a moratorium against any legal, and that's legal action of any kind against the company, not only the collection of debts by your creditors. So it protects the company, it puts a steel jacket around the company and protects it from those illegal challenges. And at the same time, it freezes all the creditors in existence on the day of rescue. It becomes a very important date in the rescue of a business, is the day of rescue. And from that date forward, no creditor who was in existence, and creditor includes shareholder loans, trade creditors, banks, staff for outstanding leave pay, etc., are all frozen at that time. What that also means is all contracts are frozen. So a bank you've got a loan from the bank, they cannot exercise their rights under that loan, and it's frozen. That doesn't mean the security disappears. It merely means that the person that is the holder of that agreement or that security cannot exercise it whilst during business rescue. The creditors then get paid out in terms of the business rescue plan. And I'm not going to go into the creation of the plan now. We'll deal with that later. But it's very similar to a business plan. It is exactly the same as a business plan, other than it's produced under a situation where the company is financially distressed. Now, in order to go into business rescue, there are two ways. An affected person, which is essentially the creditors, the employees, the shareholders, can apply to court to put it into a company into rescue. That was the case in SA Express. Or the directors can pass a resolution. It's a pretty straightforward process. The directors have a meeting. 50% plus one of them have to agree to going into rescue. They do the resolution of the meeting. They resolve to appoint one or two of their members, or how many ever, to sign an affidavit on behalf of the company. And importantly, in that affidavit, the directors have to state that they believe that given a period of a breathing space, this company will be able to trade out of its current position. If that is in existence, the directors then file that affidavit and resolution together with a form at companies, at SIPC, and the companies there from that point forward, i.e. the time that it was emailed to SIPC, the company's in rescue. The clock then starts ticking. It's all then time driven. Within a couple of days, they've got to appoint a practitioner, a business rescue practitioner. Within a number of days, they've got to call for a meeting of all creditors and staff, two different meetings. And at that meeting, the practitioners are required to basically take the assembled gathering through the plan, through the process of business rescue, and also state that he or she believes that the company can be rescued. So, and that's an important point. The practitioner has to state that on numerous occasions after the rescue date, because if at any one point in time the practitioner, in their sole discretion, believes that this company cannot be rescued, then they're obligated to put it into liquidation. Another important point is he or she doesn't have to confer with the directors. It would be strange not to, but he doesn't have to, and applies to court to have the company liquidated. Once the initial meetings have been held, there's then a time limit, 5 weeks, to present a plan. That plan gets voted on. The plan is voted on by the creditors, who have to agree to the plan. 75% of the creditors who voted. Another important point. It's not all the creditors, it's only those that voted, which can be by way of attending the meeting or by way of a proxy. And they vote on the plan, and as long as 75% of those that voted say yes to the plan, then the plan is adopted, and it becomes almost sacrosanct, and the practitioner is then instructed to implement the plan. In that voting process, another interesting nuance is that of the 75%, a percentage has to be independent. Dependent and independent, broadly, anybody that's connected with the company by way of directors, directors, shareholder loans, spouses of directors, anybody in that category that's lent money into the business, their vote is diluted somewhat. And for example, if you've got 100 Rand of creditors voting and 75 Rand of them say yes, all voting is by way of value of whatever's outstanding and due to that creditor. If 75 Rand say yes, of the total, 50 Rand have to have been independent, i.e. 50% of your total body of creditors voting. If that's all in place, the plan goes through, and as I say, it then gets implemented. It takes as long as it takes. These things are all unique in their own right. Some plans one can wrap up in 30 to 60 days. Others can take a number of years, depending on the complexity and the resistance to getting the company rescued. Maurice, I think that's about it. Just broadly to say that whilst I've stated that all contracts are frozen, the one unique category in this is staff employment contracts, and we'll cover that in a minute. But staff are not, their contracts of employment are not frozen. Maurice, I think that's about it from a high level.
Peter, thanks so much. Yes, I mentioned earlier that COBRA is not about business rescue. The idea is to informally strike those arrangements. If one does, there are other options, statutory options, that one can look at. And there's one in relation to a compromise with creditors. So this is not business rescue, but this is an option that is available. And Ian Fleming, if you can take us through Section 155 of the Companies Act as an alternative. You have a whole host of creditors out there. You cannot pay them. You have Section 155. If you just explain how it plays out. Ian, thanks.
Certainly, Maurice, thank you, and very welcome to the audience. One thing I always say is that when we start engaging with a new potential client, a distressed company, at all times we're evaluating exactly what the best route forward for that company is, and under which legal framework we should move forward. Obviously business rescue is an option, but as Maurice said, in COBRA and as a general rule, we try to keep companies out of business rescue. There's various other formats that we can work under. Section 155 compromise is one of them, informal turnaround, and some other ways to go forward. But in a nutshell, Section 155 compromise involves getting it's a turnaround practitioner will sit down and put a business turnaround plan together, a compromise plan whereby each category of creditors is compromised to an extent. In other words, each category of creditors takes a haircut, as is normally the case in a business rescue. Except in a business rescue, it's more a general haircut that creditors end up taking. And in a business rescue, creditors are normally divided between secured creditors and unsecured creditors. Whereas in a Section 155 compromise, the positive vote in favour of the plan is required by each of secured creditors, preferent creditors being SARS and employees, and concurrent creditors. So what the practitioner will typically do is he'll sit down and he'll put together a plan. He'll be negotiating it with creditors while he's putting it together. And then once he has some certainty that the plan is likely to be approved, he will pull all the creditors together, have a meeting. Each category of creditors, once again, by value, 75% vote is required by each category of creditors of the creditors who elect to vote. So once it has been passed by each category of creditors, then the practitioner takes the plan to court, says to the court, right, here's the plan, it's been approved. The court makes it's an order of court, and then it gets rolled out. It is common for the turnaround practitioner to stay involved with the company after that, in order to ensure that the plan gets rolled out properly, especially from an operational perspective. One of the considerations that we take into account when thinking about doing a Section 155 compromise is whether the creditors, they are aggressive creditors who wish to place the company in liquidation or wish to attach assets of the company, for example. In that case, a Section 155 compromise might not be the best way to go forward, because while the compromise is being negotiated and being formulated by the turnaround practitioner, it doesn't have the steel blanket of protection, as we like to call it, that business rescue can offer. So all these things need to be weighed up, and when making the decision as to how to move forward. Thanks, Maurice.
Thanks. I think an important observation there is with a Section 155 compromise, you have to go to the High Court, whereas in business rescue, you don't have to go to the High Court to have the plan approved. You'd have to go to the High Court to convert a business rescue into a liquidation. And on that score, if you enter the COBRA ecosystem now, and COBRA is unable to turn your business around, the High Court application, which generally costs between the region of 30 to 50,000 rands, is handled by COBRA on a pro bono basis. We've touched on the moratorium. The moratorium is a moratorium against claims that had arisen pre-rescue. But there's an important aspect, and it's a take-home that I ask that you all make a note of, and that is, if you go into rescue, make sure that the practitioner is alive to the fact that he or she has to send a notice out to the counterparties of agreements to suspend those agreements. If the practitioner doesn't do that, so let's take the case of a lease. if the practitioner does not send a notice to the landlord suspending the lease, that lease can still be cancelled and an eviction would still be appropriate. The same would apply if there's a breach pre-rescue. You cannot be an unlawful occupation at the time of rescue or post-rescue. And if the business rescue practitioner does not suspend the lease agreement, then it can be cancelled post-rescue, and then there's very little that the practitioner can do to avoid a high court or a MAJ court application for an eviction. So bear that in mind. Let the practitioner know if you're not going to be using a COBRA business rescue practitioner if you get to that point, and make sure that you have a list of the counterparties to all the agreements with their contact details. Give it to the business rescue practitioner, and then he or she send those notices out straight away. Contracts that so happen to not be capable of suspension, unsurprisingly, are employment agreements. Employment agreements remain exactly the same. The rights and obligations remain the same. In fact, employees are afforded greater rights because the Labour Relations Act, Section 189, continues to apply. And over and above that, they have rights in terms of the Companies Act to participate at various levels. So when it comes to dealing with employees, importantly, you cannot just implement a 25% cut across the board. That would be unlawful. You need to follow Section 189 of the Labour Relations Act. And Section 189, it deals with dismissals based on operational requirements, but you still need to follow those provisions if it's your intention to unilaterally vary an employment contract, such as by reducing a salary by 25%. So if that's your intention, if your intention is to not dismiss employees, but rather to cut their salary, give them a haircut on salary, you still have to go through Section 189. And the reason being, you still have to offer the employee an opportunity to take a severance package as opposed to agreeing to the reduction in salary. And it is for that reason that one follows Section 189. What we've seen in the past, and this is happening quite often, is we find that benevolent business owners are taking steps to assist the staff, and in fact, they're lending the company money on loan account, on a shareholder loan account to pay the salaries. And there's another important take home, and it involves the notion of post-commencement finance. And I'll be asking Peter to take us through post-commencement finance and the question of how practically ought one lend the company money in that kind of situation. Peter? Peter, you're on mute.
Sorry. Yes, an important question. The important point here is that anybody that puts money into a company prior to the day of rescue, remember I said earlier that the credit is all frozen as at the rescue date. So a shareholder or director who puts money into the business and then goes into rescue, that money is frozen and can only be paid out in terms of the business rescue plan. However, if that money is lent to the company after the rescue, so the day after the rescue or any time after rescue, it's classed as what we term post-commencement finance. And post-commencement finance is preferred in terms of the Companies Act. And what do we mean by preferred? That means that the practitioner has to pay the people that have provided funding to the company after the rescue date before he or she can pay anybody else. So there's a better chance of getting your money back. In addition, the practitioner has unfettered access to all the unencumbered assets of the company. So if there's some assets sitting in the company that haven't been used as security for anything, he can provide those assets as security to the shareholder for the loan thus received. And that becomes almost super preferent. If the company then goes into liquidation, that shareholder has to be paid out from the proceeds of the sale of those assets. So it is an important point. Do not put money in. If the idea, and often these decisions are not taken, rightly so, overnight, It often takes a lot of input from professionals. We do a lot of advice to companies thinking about going into rescue, and indeed COBRA is very much about that as well. But if you are thinking about it and it's almost certain that the company is going to go into rescue, then please hold back on any additional funding until you've gone into rescue. Maurice.
Yeah, I think whilst you on that score, PCF would also be relevant if a shareholder or director had signed a suretyship and was called upon to pay in terms of the suretyship. Peter, can you just touch on sureties, their status post-rescue, and again, PCF?
Maurice, yes. It's a question that we always ask of any directors who have come to see us about rescue. A director or anybody, not only a director, anybody who signed personal suretyship on behalf of the indebtedness of the company, that suretyship still stands. Remember, we're trying to rescue the company, not the individuals or who's ever provided the security. So you know what a common situation is, you have a group of companies, one's in difficulty, it goes into rescue, but it's been guaranteed by way of a suretyship by one of the other subsidiaries. The bank can still go after that subsidiary. Now, the approach that Ian and I take is one of collaboration, quite important to us. It's one of the foundations of our process of doing a rescue. And that's collaborating with all parties, but particularly in this instance, the shareholders and or directors. Because the last thing you want is a director who's distracted from running the business because he's aware at the back of his mind that he's signed this personal suretyship, which might put the family assets at risk. And that's inappropriate if you're trying to rescue the business. So we will often, on behalf of the director, negotiate with the bank or create a clause in the plan that allows that security to be settled in some form. But an important point that people aren't off the hook merely by issuing security. If a suretyship has been issued and it's an amount that can be afforded by the director or the shareholder, it is often worthwhile settling that security. So if it's the bank, the director shareholder can settle that security by paying the bank back and thereby becoming a preferred creditor by way of PCF, because it's putting money into the company to settle in indebtedness of the company. You're converting one creditor from one to another, but that person steps into the shoes and is now preferred because that's money that's been put in to the business after rescue. Maurice.
Yeah, brilliant. Thanks for that, Peter. I spoke of labor. I'd like to turn to practicalities of a business rescue. Ian Fleming, CEO of Engaged, he's a business rescue practitioner himself. What's it like on the ground? What do you do, Ian? So the resolution's been passed, the directors have resolved, you've been appointed. What happens?
Maurice, within 10 days of us being appointed as the business rescue practitioners, we then have to hold 2 meetings. One is the Section 147 meeting with the creditors, and the other one is the Section 148 meeting with the employees. The purpose of that meeting is really to express to the creditors and to the employees whether or not there's a reasonable prospect, whether or not we believe there's a reasonable prospect of rescuing that company and taking it back to a solvent going concern. Obviously, under business rescue, you're allowed to give creditors a better return than in liquidation. That has become, it's not necessary for the company to be returned to a solvent going concern, although this was the original intention of business rescue. Employees will obviously want to know what the likelihood is of them being able to retain their jobs, and therefore what the likelihood is of you being able to return it to a solvent entity. Therefore, we like to give insight sort of at the first meeting as to what we believe is the likelihood of actually saving a whole or a part of the business, because that's really what the employees want to know. We all know about a very interesting judgment in SAA that came out a few weeks ago by the Labour Court, whereby it was effectively ruled that a business rescue plan had to be published and approved before a retrenchment process could commence. Now, this has obviously made it very interesting for business rescue practitioners, because we are normally used to commencing retrenchment processes whilst the plan is still being formulated. And the Labour Court judgment, which is now under appeal, has effectively prevented us from doing that. Now that makes, there's a couple of things that this brings into play. It makes it very important for the business rescue plan to be published as quickly as possible and approved. And it also brings into the equation the fact that you need to pay employees up to the stage of the business rescue plan that obviously envisages retrenchments is approved. And should it be a few months whilst we wait for the business rescue plan to be approved, whilst we're preparing it and so on and negotiating it, then we need to pay all the employees during that time. And many of them might not be working, as you can imagine, in the current environment. So it can be a huge drain on the company's remaining cash resources, the impact of this Labour Court judgment. But Peter and I were speaking to the lawyer who represented NUMSA and the Cabin Crew Association, and who obviously won in court a few weeks ago. And we said to him, so this effectively means that you can commence a retrenchment process all the way up to the beginning of business rescue, and then you can commence a retrenchment process after the business rescue plan has been approved. But in the gap, whilst you're preparing the plan, you can't commence a retrenchment process. So it is a little bit counterintuitive, we believe. But we'll wait to see what the appeals court judgment says. But yes, sorry, Peter, it looks like you want to say something?
Yeah, and just a couple of things. I didn't catch whether you said that this case its appeal has been approved, so it is going for appeal. The other interesting thing in the judge's summing up, he said that until a draft business plan is issued. So it doesn't necessarily mean up to the date once it's approved and adopted. It's actually just in draft, which is also an interesting thing because it's not yet approved by the creditors, and yet we're putting on hold this massive process of a Section 189 staff reduction. And then you sort of say, well, it can also be in draft. Now, if you just think of the absurdity of that, not in SAA's case, because it's going to be a very complicated business plan, but you could just rattle out a sort of cut and paste draft, stick it out there and say, well, there's my draft. And now that it's out, we're going to go through the 189 reduction. So there is an anomaly. I think the courts in the appeal will take all of that into account, and hopefully we get a certainty once that appeal has been heard.
Absolutely. But what we've been doing is, should I touch on the variable cost aspect, Maurice?
Yeah, absolutely. Please continue.
We've been, as Maurice said, you've got to, if you commence the Section 189 process, you need to, or if you want to reduce staff salaries, you have to do it as part of the 189 process, and that's exactly what we've been doing. Right from the beginning, we said that we think this COVID-19 crisis is going to change the way that companies do business substantially, and that is that all what business considered to be fixed costs previously are largely going to change to becoming variable costs. So we will no longer be considering staff costs, for example, to be fixed costs. We'll no longer be considering landlord or rental costs to be fixed costs. Landlords are inevitably going to move to turnover-based rentals, and staff costs are inevitably going to become more variable. In effect, everybody's going to become an entrepreneur. The remuneration that a staff member earns is going to be so much more tied directly to what their output is, to what they produce. And as part of the process, we have been, as part of the Section 189 process, we've been putting staff we've been negotiating with them, and they've been very happy to reduce their salaries as opposed to being retrenched, knowing that at the end of the day, they'll most likely still have a job. And then as the company starts growing again, once the revenue starts growing, then they can obviously, their salaries will normalize to what they were before, however long that might take. This can be done in various ways. It can be done by simply stating that, simply telling the employees or negotiating with them that their salaries get dropped to 25%, for example, of what they were before. And then over time, as turnover increases, then we increase their salaries proportionally. There's a even more transparent way of doing that, and which we've also done, is to say to the employees, right, our turnover is currently 0. Therefore, we'll pay you. We have remaining cash reserves, and we can pay you 20% of your salary for the next 3 months. And then, as turnover increases, we will publish our turnover every month, and you will receive 30 or 40% of whatever the turnover might be. Completely transparent process. Employees understand that they cannot get paid anything if the turnover of the company is 0. But then, as the turnover increases, they see what the turnover is, and they know exactly what percentage of the turnover is going to go towards paying their salaries.
Yeah, absolutely. Thanks for that. On the question of the funds that have been made available, the audience's attention is drawn to the fact that we have a knowledge base which is hectically comprehensive. So please go to the COBRA website if you need assistance on that. I'm going to turn to the question of a business rescue practitioner and what happens if there's been malfeasance in the company. Now, all too often what's happened is directors are reluctant in appointing a business rescue practitioner because they've been understating their income or overstating their expenses, and now they're concerned. So if Peter can take us through the duties of directors pre-rescue, duties of the business rescue practitioner apropos directors pre-rescue and post-rescue. Peter?
Maurice, yes, I mean, very often, because it's a very practical question, directors are sitting with us and say, we want to go into rescue, but we've done something normally in relation to tax. We've done something that we're not particularly proud of. We've, evaded tax in some form or another, as opposed to avoided, which is legal. And what's going to happen to us? Now, that's a transparent process. Very often you don't find this out until afterwards. If the directors disclose that to you before you've gone into rescue, obviously the person in receipt of that information is not obligated in terms of Chapter 6 of the Companies Act. There might be other legislation, and Maurice, I'll leave you to cover that. I'm not a lawyer, I'm an accountant. But there might be other situations where the recipient of the information does have to hand it over to the authorities. There is now an important point here that the practitioner is obligated in terms of Chapter 6 of the Companies Act to investigate the affairs, verbatim from the clause, the affairs of the company, and if he finds that anything has been done that is contrary to the law, then he's obligated to report, firstly, to report that to the relevant authorities, not defined. Now, a relevant authority could be popping down to the local police station and making a statement. I would argue that's inappropriate. If you're dealing with a company, for example, I've had experience in the financial services sector, and those are FSPs regulated by what was the FSB, now the FSCA. And if in all those cases, I've reported it to the FSCA because they are the regulatory authority for that particular company. You could equally report it to Sub-C and hope they're going to do something about it. The next point of the practitioner, you must make sure that the management stroke director of the company cease from doing whatever they were doing, and then make sure that it remains that way. Now, the important point here is, as I said earlier, it's normally SARS that's been done down in some form or another. And certainly, Ian, and my experience is we will approach SARS. Once we've got to grips with the numbers, often quite a difficult thing to do, certainly in the SMME space, getting to grips with what the reality is. But once we've got the figures and know what the tax should have been, is approach the revenue, and that's taxes of all forms, obviously VAT, PAYE, or income tax. Approach the revenue, make a full declaration, and then what you often find is 9 times out of 10 there's likely to be a compromise in the business rescue plan. That is that creditors are going to be offered less than they were claiming, so we're going to offer a dividend of 50 cents in the rand or 40 cents or whatever it might be, which ties in with the overall scheme of the plan. And once you've done that, obviously revenue's caught up in that as well. So the amount paid to revenue is probably back to where you would have been anyway. So very often you find it's a fear that directors have, and it's ill-founded, because once they see the facts, and an important thing, and Ian often says this when we're in meetings, is SARS are not there to put companies into liquidation. It isn't their raison d'etre. SARS are there to keep a company going because they recover more tax as a result. Now, they're obviously going to take their penalties and they're going to claim interest and all those sort of good things. But as I said, once you've been through that process, you get back to the status quo. The one important thing, however, is if directors have done anything that is fraudulent, totally illegal, then there could well be a criminal charge against the director. And again, I said it earlier, the practitioners are not there to protect the directors, they're there to protect the creditors on behalf of the company on behalf of the creditors. The whole thing is to see how much we can pay the creditors out of this process. So, but once again, if, assuming that it is merely a slip of conscience and something was done, we can deal with that. But it's important to state here that one of the most critical things that we can't demand it, but we seek, is trust. Because if you don't have trust between the practitioners and the directors, it makes for a very difficult rescue. I've done a couple in my past where there's been fraud, and those are fraught with problems, because you're being given double stories, you're being given incorrect information. And very often, remember, we've had it is requirement of the Act not to have had a relationship with the company beforehand. So the practitioner walks in completely nude as to information, and has got to garner that information as quickly as possible. And very often, if it's fraudulent stuff that's been going on, then people are doing their damnedest to hide it all. So it becomes very difficult at times. But in those cases, then obviously, if it's criminal, a director can be reported to the police. And whether they do or don't take action, of course, is an interesting problem. I've done a number of rescues where creditors come to me and say, these guys were frauds and they should go to prison. Or remember, we're rescuing the company. If there's money to be had at the end of the tunnel, then it's worth pursuing, because we'd be garnering money to pay the creditors. But if there isn't, then you're just spending good money and doing the state's case for them, which is totally inappropriate. Maurice?
Yeah, thank you. The legislation that you said I'd speak of would be Section 34, dealing with corruption. It's a statutory offence to not report a fraud which involves a value in excess of 100,000 rand. So every citizen is obliged, every person is obliged to report the crime of fraud if it involves amounts in excess of 100,000 rands. Interestingly, I was reading the Dudumnyeni SAA judgment, and obviously that deals with fraud, dishonesty, and the like on the part of Dudumnyeni. But in there, they touch on the business judgment rule, which is found in our statute. The business judgment rule recognizes the fact that directors can make really, really bad decisions. And the business judgment rule says they must not get into trouble for those really, really bad decisions, so long as you acted in good faith. So if you act in good faith, you cannot get into trouble unless you contravene a law. And you can't say, well, I didn't know about the law, I was acting in good faith, because ignorance of the law is no excuse. So I'm going to move over to Ian. An anxiety that, again, arises is how do directors, the role of directors and their role and their relationship with the business rescue practitioner practically. Can you just take us through that, please?
Yes, Marie. So obviously it is when the business rescue practitioner steps in, then he takes control of the board, and in substitution for the board's powers. But the board of directors still have duties. They've still got the fiduciary duty and so on. And effectively, they need to answer to the business rescue practitioner at the end of the day. But as Peter said, we really try to foster a collaborative approach. And this is a very common theme that comes through. When the relationship of trust is very important between the directors and the business rescue practitioner. You find a lot of business, but that's why you need a good business rescue practitioner as well. Somebody who is a business person, and somebody who understands the sort of cuts and thrust of distress, and understands the machinery of a business and of a board. You'll get some business rescue practitioners who come in, and the first thing they do is kick the CEO out of his seat, and send him home, and think that they can run the business. The fact of the matter is that we as business rescue practitioners stepping into a business will never have the same the relationships with suppliers, the relationships with customers, the intimate knowledge of the business that the CEO and his board have built up over many years of running that business. So that's why the choice of business rescue practitioner is so critical to the success of a business rescue. A lot of people think that the business rescue practitioner is 99% of the determinant of the success of whether it will work or not at the end of the day. But yes, the board are required to work with the business rescue practitioner, and yes, it's very important. We like to kind of wipe the slate clean as to whatever directors might have done in the past, and give them the opportunity to work with us going forward. Inevitably, as Peter said, we both had cases where the board has not wanted to work with us. They've been hiding things from us. They haven't disclosed everything. They're kind of doing deals behind our backs. Unfortunately, that always kind of deteriorates into a situation where we as the business rescue practitioners have to take control. And it inevitably becomes acrimonious. And sometimes we need to consider in those situations simply putting it into liquidation. Alternatively, winding the company down under business rescue. It's almost impossible to rescue a company where there is a lack of trust and animosity, or where there is animosity between the directors and the business rescue practitioners. Therefore, returning the company back to a solvent going concern in those situations is almost impossible. That's why it is so important for a strong, healthy relationship of trust to be built up between the directors and the business rescue practitioners. And of course, what is required for that is for the directors to be reasonable people, and for the business rescue practitioner to be reasonable, competent people.
Certainly. Thanks for that. Peter, a business rescue practitioner who is misbehaving, what does one do about that? Before we get there, I just want to mention that to become a director of a company, you do not need a qualification, a formal qualification. Interestingly, when it comes to business rescue practitioners, they need business experience or accounting experience or legal experience. So the beauty is you getting somebody who has a qualification, chances are, like the engaged team. They're mainly chartered accountants, and they come in and they've got proper skills. You bring in somebody who in essence is a financial director who day in and day out rescues companies. So there is a massive advantage there. Peter, business rescue practitioner misbehaving, what then?
Maurice, yeah, look, unfortunately, a lot of practitioners haven't showered themselves in glory, and hence some of the negative publicity that was very much prevalent in the early days of business rescue, but continues to date. You've made an important point there, Maurice, and one of the things that certainly had engaged, we have a team. This is not just Ian and I. So you mentioned accountants. There's a bunch of accountants. There's a couple of junior lawyers with us. These operationals people, these people that have HR skills. I'm also a corporate financier, so I do capital raising and selling and buying of businesses. So there's a breadth and depth of experience. Anybody can see from my photograph that's up is that I've got enough grey hair. I've been in business over 40 years, so one's tapping into that in the rescue process. However, if a practitioner is not complying with the law, firstly. Then, one can demand that he rectifies it. I get this very often. We do advise people, creditors on the other side of business rescue, who are faced with a business rescue and wondering how they can recover what's owed to them. Now, complying with the law, a practitioner has to communicate with creditors. He has to involve them in all legal action that he's taken in the company. He's got to be, it's all time driven, as I said earlier. He's got to publish the plan. He's got to have a vote on that plan within 10 days, etc., etc. Won't go into all the timing, but there are a lot of key dates that are triggered by Chapter 6. Now, if those are missed, obviously a practitioner can go back and say to the creditors, look, I missed by 1 day or I missed by a few days. But I've had cases where creditors just haven't been advised for months, and not months, years in one particular case I'm dealing with. And in a case like that, one has to go to court, because that's just not a slip of a couple of days or a couple of weeks. This is a major dereliction of duty. The other important thing to mention here is directors all know, and if they don't, then they shouldn't be directors, that you pick up full fiduciary duty in respect of the company. Now, those duties are relieved slightly in business rescue, but only slightly, because the practitioner steps in what is called a supervisory position over the board. And the business rescue practitioner, importantly, picks up those full fiduciary duties. So he or she has an obligation to act in the best interest of the company. Now, if they're not doing so, and certainly, and I'm not touching on illegal things yet, but not doing so in so much as proper decisions aren't being taken, information's not being properly handled, and the administration and the practical side of the rescue are not being handled properly, then any affected person, remember, shareholder, staff, or creditor, can approach the courts, or a director could approach the courts, even if they're not a affected person. They normally are, but especially executive directors, because they're getting salaries, so they are affected, and can approach the court to have the practitioner removed. And there have been a couple of cases, not necessarily for wrongdoing of companies, but of practitioners rather, but rather where we had this in the Oak Bay situation, where the shareholders weren't particularly pleased with the stance the practitioners were taking, so approached the courts to have them removed. So yeah, I mean, if the practitioner is acting in bad faith and does anything illegal, then obviously there's direct recourse to court to have them removed. But it is an important point, and we always say one of the things, if you're once considering a practitioner, and we're not here polishing our own marbles, but find somebody that's been in business, not knocking the lawyers that are sitting or the accountants that are sitting around the table. Very often you find highly professional people that know the rules, whether that's IFRS in accounting or all the laws in the legal profession, aren't necessarily good business people. Ex-bankers are often not good business people. So please do yourself a favor and make inquiries of the people that you're thinking about appointing before doing so. Thanks,
you do get lawyers that are business people. I'd like to think of myself as one.
No, sorry, yes, this is not a criticism. As I say, I'm an accountant, but I also know a lot of accountants that haven't a clue how to run a business.
Moving to the business rescue plan, its contents, how that works. Jan?
Maurice, the business rescue plan is basically a business plan that sets out how the business rescue is going to unfold, as the business rescue practitioner believes it's going to unfold at the time of publishing it. Broadly, it contains a statement of what the company's assets are, a statement of what the company's liabilities are, liabilities broken down into secured creditors, unsecured creditors, whether the creditors are independent or whether they are not independent. It breaks down, and then it sets out verbiage as to what the business rescue practitioner intends to do, how he intends to decrease costs, how he intends to improve revenues, improve gross profits, etc., etc. So it deals with a lot of operational aspects, it deals with a lot of financial aspects, it deals with a lot of legal aspects. Most and a very important part of the business rescue plan is a comparison to what the company will receive in a liquidation scenario versus the business rescue scenario, or comparison of what the creditors will receive in a liquidation scenario versus a business rescue scenario. It is very important for a business rescue plan to prove to the creditors that they will get a substantially better return than they would get in a liquidation scenario. Liquidation is, of course, always an option or an alternative to business rescue. So yes, that is a fundamental part of it, and there's no point in showing that, for example, the company in liquidation, the creditors will get 20 cents, and in business rescue they'll get 21 cents. It needs to be a substantially better return for creditors than in liquidation. Now, 3-year financial projections are also an important part of the plan, and we all know that projections are inherently unreliable for the fact that anything can happen that's not expected. COVID-19, for example, how could anybody who did a business rescue plan a year ago have predicted COVID-19 happening, which obviously would have had a fundamental impact on many business rescue plans. And various internal and external factors can take place that materially affect the financial forecasts in a business rescue plan. So that's what we always say, that the business rescue plan and the financial projections in the plan have to be the practitioner's best estimate as to how the company is going to roll out, how the business rescue plan is going to roll out at the date that he prepares that plan. Because very often, 3 days later, things could have changed. It's a very fluid and imperfect environment that we operate in, and therefore you cannot expect the financial projections always to pan out exactly as expected. But that's the long and short of it, Maurice. That's a business rescue plan. I think Peter stated earlier that 10 days after the business rescue plan is published, the creditors then need to, we have what we call a Section 152 meeting, where all the creditors get together. Everybody who wants to cast a vote appears at the meeting, either in person or by proxy, and votes in favour of the plan. For the plan to be approved, 50% of creditors by value who choose to vote, of independent creditors, need to pass the plan, and 75% of all creditors by value who elect to vote are required to pass the plan.
Yeah, on the voting, Peter, can you take us through this example? We use it quite often because we have trade creditors at 10,000 rands and shareholders at 1 bar and directors at 2 bar on loan accounts. So if you just take us through how the voting of a plan would work there. Peter,
Peter, you're on silent.
Sorry, guys, it's Monday morning. I'm having some difficulty with my mute button this morning. I'm becoming a bit of a mute. The important thing with the voting I covered briefly earlier is on the 75% rule and the 50% independent. But when you've got a situation like this, the shareholders in Maurice's example on the screen are not independent, neither the directors, but the employees are. So you've got this absurdity here, and I mean, this is an extreme example that Maurice has put up just to indicate the point. But this is not uncommon, that you have a situation where your shareholders have got significant loans due to them, or non-independent people have got significant loans, might be intercompany loans. And what you have to do is almost the juggling act to make sure that you don't have that independent-dependent rule exceeded, so that less than 50% of the independent creditors have voted, resulting in a plan that doesn't go through. So we will often, having calculated the numbers beforehand, suggest to a creditor, or in this case a shareholder, who's got R1 million loan to the business, to only vote on a portion of that loan, so that they still have their vote. But at least by that way, you know that the plan is going to go through. That's assuming, of course, that your shareholder, directors, employees are all supportive of the plan. But in this case, where you've got a minor creditor of 10,000, he's going to vote alongside the employees. So if the employees are all on the plan, this will carry. But if that employee figure was 0 and you've got a 10,000 creditor loan, it's worthwhile to get somebody to buy that loan. It could be a shareholder buying it, or an independent party can come in and buy it, possibly at a discount, and buy that loan, and it's somebody that supports the plan. There's nothing to stop people trading in the debt of the company whilst it's in rescue, also very commonly done. So somebody is, you know, my example right earlier of the secured personal suretyship, that shareholder can come in and settle that, buy that claim off the bank or whoever, and therefore settle them, and then have a claim in the rescue, carrying the same security. So, you know, albeit frozen security, could in fact have the security cancelled and put the money into the company and pay that creditor, and therefore be classed as a preferred creditor. So the bottom line on this is every case is unique, and it is important to look at the facts of the case to decide what is the most appropriate action, because clearly the focus for us is to get the plan approved. If the plan's not approved, it goes through a process, and I'm sure we'll cover that. But you know, if your plan's not approved, it just adds time, complication, and cost to getting the thing, and could unfortunately end up in a liquidation. And if everybody's of a like mind that they're trying to rescue this company, then surely one's got to come and make sure that your plan, first of all, meets the requirements of most creditors. It's never everybody winning. Somebody, and you're trying to be as fair as possible across the piece to make sure if anybody's taking pain vis-a-vis a reduction in what's paid to them, that it's done. It has to be done transparently, and it has to be done on a uniform basis. You can't prefer one creditor, an unsecured creditor, over another. But as I said earlier, security will still stand. So your secured creditors and your preferred creditors will be paid out first, and then the concurrence. But it has to be equal across the piece. You can't go and treat one creditor differently just because they've got a different case.
Great, thanks for that. Final question for Ian. Going back to the plan, Ian, is it possible to have a plan where all creditors swap their debt for equity or subordinate their debt until the financial well-being of the company is restored?
Yes, Maurice, it is absolutely possible. Any change in shareholding structure, however, needs to be approved by a majority of the shareholders by value. So that is the only requirement. But yes, it is possible, and it obviously needs to be negotiated with the shareholders in advance of proposing something like that in a plan. Peter, you look like you want to say something.
No, but I can add to that. I mean, we've had one of this very recently where your shareholders have got a significant loan to the company, and we're happy to capitalize their loan to improve the equity, and we had a minority shareholder. So we called a shareholder meeting. The minority was a 15% shareholder. He was acrimonious in the process, did not turn up to the meeting. He had the chance to vote on the plan. He chose not to vote, and then it carried, and we capitalized a significant shareholder's loan. And, in one fell swoop, restored the solvency of the company, not necessarily the financial sustainability of the company. But by doing that, the shareholders, the recalcitrant shareholder became less than 1% shareholder in the business. So it is something that one very often does.
Great. That's a wrap for today. Please join us tomorrow at 9 o'clock. We have Martin Kingston on, who is a not to be missed webinar. It is a bit earlier. He was only able to make it at 9 o'clock, so please make a note of that. I'd like to thank my panelists. Thank you so much for being here today, and to the attendees. If you want more information, go to www.cobra.org.za or send us an email, info@cobra.org.za. To my panelists, thank you very much. To my attendees, thank you. Bye-bye.